अस्सलाम वालेकुम फ्रेंड, उम्मीद करती हूँ आप सब खैरियत से होंगे। आज मैं आपको बताऊंगी फ्यूचर ट्रेडिंग के बारे में। व्हाट इज़ फ्यूचर ट्रेडिंग? फ्यूचर इन स्टॉक मार्केट definition, example and how to trade. What are futures? Futures are derivative financial contracts that obligate parties to buy or sell an asset at a predetermined future date and price. The buyer must purchase or the seller must sell the underlying asset at the set price regardless of the current market price at the expiration date. Underlying assets include physical commodities and financial instruments. Future contract detail the quantity of the underlying assets and are standardized to facilitate trading on a future exchange. Future can be used for hedging or trade speculation. Key takeaways: future are derivative financial contract obligating the buyer to purchase an asset or the seller to sell an asset at a predetermined future date and set time. A future contract allows an investor to speculate on the price of a financial instrument or commodity. Futures are used to hedge the price movement of an underlying asset to help prevent losses from unfavorable price changes. When you engage in hedging, you take a position opposite to the one you should hold with the underlying asset. If you lose money on the underlying asset, the money you make on future contracts can mitigate that loss. Future contract trade on a future exchange and a contract price settles after the end of every trading session. Practice trading with virtual money. Underlying understanding feature are also called future contract allow trades to lock in the price of the underlying asset or commodity. These contracts have expiration date and set price that are no upfront. Future are identified by the expiration month. For example, a December gold future contract expires in December. Trades and investors use the term future in reference to the overall asset class. However, there are many types of future contract available for trading, including commodity future with underlying commodities such as crude oil, natural gas, corn, and wheat. Stock index future with lying assets such as S&P 500 index currency future, including those for the euro and the British pound. Precious metal futures for gold and silver. US Treasury future for bonds and other financial securities. It's important to note the distinction between option and future. American style option contract give the holder the right but not the obligation to buy or sell the underlying asset any time before the expiration date of the contract. With European option, you can only exercise at expiration but do not have to exercise that right. The buyer of future contract, on the other hand, is obligated to take possession of the underlying commodity or the financial equivalent at the time of expiration and not any time before. The buyer of a future contract can sell the position at any time before expiration and be free for the obligation. In this way, buyer for both option and future contract benefit from a leverage holder position closing before the expiration date. Ports investors can use future contracts to speculate on the direction of the price of underlying assets. Companies can hedge the price of the raw material or product they sell to protect against adverse price movement. Future contract may only require a deposit for a fraction of the contract amount with a broker. Cons: investor risk losing more than the initial margin amount since future use leverage Investing in future contract might cause a company that has to miss out on favorable price movement. Margin can be double in edged sword, meaning gain are amplified, but so too are losses. Using the future market typically has high leverage. Leverage means that the trader does not need put up 100% of the contract value amount when entering into a trade. Instead, the broker will require an internal margin amount, which consists of a fraction of the total contract value. Important, the amount required by the broker for a margin contract can vary depending on the size of the future contract, the credit worthiness of the investor, and the broker term and condition. The exchange where the future contract trades will determine if the contract is for physically delivered or if it can be cash settled. A corporation may enter into a physical delivery contract to lock in the price of a commodity it needs for production. However, many future contracts involve traders who substitute on the trade. These contracts are closed out of netted the difference in the original trade and closing trade price and have a cash settlement feature. For supplication, a future contract allow a trader to substitute on the direction of a commodity price. If a trader bought a future contract and the price of the commodity rose and was trading above the original contract price at expiration, then they would have a profit before expiration. The future contract, the long position, will be sold at the current price, closing the long position. The difference between the price will be cash settled in the investor brokerage account. The no physical product will change hand. However, the trade could also lose if the commodity price was lower than the perhaps price specified in the future contract. Speculators can also take a short speculative position if they predict the price of the underlying asset will fall. If the price does decline, the trader will take an offsetting position to close the contract. Again, the net difference would be settled at the expiration of the contract. Investor would realize again if the underlying asset price was below the contract price and a loss if the current price was above the contract price. It is important to note that trading on margin allows for a much larger position than the amount held by the brokerage account. As a result, margin investing can amplify gain, but it can also magnify losses.